Welcome one and all for our regular second Saturday webinar. Before going into the presentation, yesterday in US market, US May month inflation was released. It came much higher than expected. The consumer inflation came at 8.6% against the expected 8.3%. Because of this stubborn high inflation, markets are now expecting US Fed to increase the rates very aggressively in the coming months. Now markets are expecting 50 basis point hike in interest rate by US Fed on 15th meeting, that is next week. Then in July, another 50 basis point hike is expected. And in September, another 50 basis point hike is expected by US Fed. So overall 1.5% increase in interest rate is expected in next 3 US FOMC meeting. Because of this, market tanked very sharply yesterday overnight in US market. Both Dow Jones and Nasdaq fell very sharply. Dow Jones down by almost 880 points and Nasdaq too fell. We expect our markets to open negatively on Monday morning. Not only our markets, entire global markets are expected to be weak on Monday. Now coming to our markets are weak. Last month we saw some pullback happening, but still the pullback was very feeble. FIs were continuously selling. They have sold almost 28 billion worth of shares since October, one of the highest in recent years. And if you see in the month of May, also they sold heavily, almost 5 billion they have sold. And the selling is continuing. Even yesterday, foreign investors have sold near to 4,000 crores worth of shares. So because of persistent selling by foreign investors, in spite of buying by domestic funds, market has been tanking. And if you see market very closely, you can sense that every day one sector will keep on falling. 2 days back, cement sector fell very sharply on news of Ultratech announcing their expansion. And yesterday, if you see, means a bank fell and IT stocks fell. So on each day, some sector has been taken and heavy selling has been happening. Mainly FIs are selling heavily. We expect the foreign investors selling to continue for another couple of months. It's not going to stop immediately unless the Russia-Ukraine war stops. Till then, the FII selling will continue. The other macro event which has happened is that, as expected, RBI has hiked the interest rates this week by 50 basis point. We expect more hike to come, and we are going to see in detail how much RBI going to hike interest rates and what is the implication on our market. We are going to see in coming slides. So the two main problem in the market currently is the high inflation, thereby central banks are going to increase the interest rate. And second one is that, which is particular to our market, is the heavy FII selling. And if you see that the crude oil and natural gas prices are again going up from the elevated levels, and because of high elevated energy prices, we expect that inflation to remain stubborn worldwide. Especially if you see in US, inflation is not going to fall in near term because of high energy prices and high food prices, which means that US Fed is going to be very aggressive. And if US increases interest rate, means naturally every other central bank will start increasing interest rates. And ECB, European Central Bank, already told that they are going to stop quantitative easing in this month, and from next month onwards they are going to hike interest rate. So globally we are seeing a tight monetary policy whereby the liquidity is going to come down as well as interest rate is going to go up, which means that market will remain either sideways or on downturn. And another interesting factor happening in our market is that the volumes started drying. And a few months back, our daily cash market volumes were around 60,000 crores to 80,000 crores. Now that has drifted below 45,000 crores. That means market participants has come down. Why this has happened? Mainly those who have bought shares, they are stuck with that. somebody who bought shares at 100 rupees, now price has come down to 80 rupees, means naturally they will hold on the shares, and the majority of them will hold on the shares and they won't sell it. And suppose if price goes above 100, means they will sell that share and will buy another share, and thereby churning will happen. Since most of the recent buys are in losses, the churning has come down, thereby the market volume has come down by around 30-40%. From 60 to 80,000 crores, the cash market volume in NSE has fell now below 45,000 crores, which means that the participation has reduced, which indicates that most of them are stuck with shares which were bought at higher prices. And in the last 1 month, Nifty and Sensex has gone up by around 2.5%, whereas mid and small cap around 2%. And we expect that on Monday opening, market may fall because of the weak global cues. And this is the inflation data. In our inflation data, CPI inflation is near to 8 in our country, and WPI inflation is at record level at 15%. Before, when we got this inflation, WPI inflation is that before 2000, that is more than 20 years, 22 years back, we got this type of inflation in WPI. Now we have reached that level. That means WPI inflation is almost a 24-year high we are seeing now. The CPI inflation, if you see that, it has been plotted only from 2012, because CPI government introduced the CPI inflation in 2013-14 period, with effect from 2012 backdated. They announced, they started disclosing the CPI inflation, and for any monetary policy action, government is taking only CPI inflation into effect. They won't consider WPI inflation. RBI will not look into WPI inflation, but they will see only CPI inflation for any monetary policy action. See, why RBI is increasing the interest rates if inflation is higher? That many of them are asking. See, basically RBI or any central bank, they have only two main mandates. One is that they have to keep inflation under check, and the second one is that they should create as much employment as possible through economic growth. So basically RBI has two mandates. One is the keeping inflation under check, and the second one is the employee generation through economic growth. And if you see that now the inflation has gone to 8%, the mandate given to a monetary policy committee is that inflation in India should be kept around 4%. That is the allowable limit. The maximum tolerance level is 6%, and a lower band of the tolerance level is 2%. So in India, inflation can be between 2 to 6%. That is the limit given to RBI, and it's the RBI job to keep the inflation between 2 to 6% with 4% average. Now, if you see that inflation has gone above the upward tolerance level of 6%, now RBI is forecasting for the next 9 months, the inflation is going to be above 6%. Suppose continuously if inflation goes above 6% for 3 quarters, for 9 months, means then RBI has to give explanation to the government why inflation has stayed above 6% and what went wrong. That explanation RBI has to give. That means the primary job of the RBI is to keep inflation less than 6%, between 2 to 6%, around average of around 4%. Now that tolerance level has gone up, and what they are forecasting is that RBI forecasting is that in the next 6 months the inflation level will be above 6%. That means after another 6 months, RBI will give explanation to the RBI. For the first time, RBI will give explanation to the government why they could not able to control the inflation. So for controlling inflation, there are two ways are there. One is by reducing demand, and second one is the increasing supply. Inflation basically comes due to two reasons. One is, suppose if supply gets choked, means then there will be shortage of goods, then price will go up, inflation will come. That is one part. The other part is that if demand is too strong, where more people want to buy things, but the available is only limited, means at that time also the price will go up. Now, what has happened in the last 1 to 2 years is that because of COVID crisis and a recent Russian issue, the supply side, uh, there was some issues were there. Companies could not able to produce enough products, as well as due to Russia-Ukraine war, there was a huge supply side issues in crude oil and other energy prices, which led to higher cost. The on demand side, because of very loose monetary policy, excess money was available uh, through many of them, and thereby the demand also was high. Now RBI, what they are going to do is that they don't have control on supply side, because of the war, they could not increase the supply immediately. Even if they take steps, government takes steps, supply will go up only after, it will take some time, 1 to 2 years it will take. So the only way to reduce inflation is by reducing the demand, and one of the way is that by increasing the interest rates, you can reduce demand, and EMI will go up, and all the suppose if RBI increase interest rates, what will happen? EMI will go up, and out of 10 people who want to buy a product through EMI, two or three may take a back seat because of higher EMI. Previously, 1,000 rupees EMI would have been there. Now, because of increasing interest rate, 1,200, 1,100 or 1,200 EMI will come. So, out of 10 people, two or three may take a back seat because they could not able to afford, and thereby the demand will come down. So, through increasing interest rate, there is a possibility of demand coming down. That is why RBI is increasing interest rate. And as expected, RBI has hiked the interest rate by 50 basis point in a recent monetary policy meet, and we expect that another rate hike will come in August. Another 50 basis point rate hike will come in August, and the first impact of that is that EMI have started going up, and many loans are tied with external price, which is the repo rate. So whenever RBI increases repo rate, naturally the interest cost will go up for the loans. And if you see that HDFC has hiked interest rate and Kotak Bank has hiked interest rate, almost every bank where the loans are tied with the external benchmark, the EMI will start going up. So roughly, if you see that if RBI hikes interest rates by 50 basis point, EMI will go up by 4%. So already two rate hikes have happened, 40 basis point last month and 50 basis point now, and more to come. And what we are expecting is that in next 6 months, we are expecting that housing EMI and whatever loans people are taking, it will go up by around 15% higher when compared to what it was before April. That means somebody paying 30,000 rupees EMI per month, and 15% hike means around 4,500 rupees will increase in the initial rate hike cycle. That means somebody who has been paying 30,000 rupees EMI in the month of March, they may have to pay around 34,500 or 35,000 in the month of November or December by 6 months from now. So the overall, we are expecting 15% increase in EMI in the next 6 months. That means those who can afford, they can pay higher EMI, and whereas those who cannot afford, what they will do, they will cut other expenses and they will continue to pay the EMI. So overall, the objective of the hiking rates is to slow down the economy. US Fed has only one objective, mainly to fight against the inflation. Whereas if you see the RBI, they have other objectives also for hiking rates. One is to keep rupee stable. Suppose if Fed keeps on increasing interest rates, and if RBI doesn't increase interest rate, means what will happen is that rupee will start weakening very quickly. So in order to avoid that, also RBI is forced to hike rate. Even if inflation comes down in our country, we have no other way to avoid hiking rates, because the interest rate differential will become very large, thereby the rupee depreciation will be very fast. So RBI has to hike rates till US Fed hikes rate. And this is the repo rate chart, and we have seen two hikes, last month by 0.4% and this month by 0.5%. What we are expecting is that another 2 to 3 rate hikes will come, thereby the repo rate will be around 6%. It may be around 5.75%, or it may be around 6.25%, in that range, and it will stabilize around 6%. That is what my expectation is, that RBI will keep on increasing the interest rate in coming months, thereby the repo rate will stabilize around 6%. Because right now the inflation is around 7, the repo rate is around 4.9. That means more than 2.5% interest rate differential is there. That is a negative interest rate is there, and RBI will hike in such a way that the interest rate, negative interest rate, will become 0. That is what our expectation is, and most probably repo rate will stabilize around 6. It may stabilize around 5.75 or around 6.25, and overall it will be in the range of 6%. So the first rate cycle, it will go there around 6%, and after that it all depends upon how much at what level crude oil price will stabilize, at what level the US inflation will be there, and US Fed, how long they are going to hike the rates. That is and depends upon that, the next rate hike cycle will happen. And if you see the commentary from most of the companies, and it's an annual reports season, and if you see that majority of the company, we can see in annual report that they will be using the word inflation, because it is an unprecedented inflation the companies have seen in the last many decades. This type of inflation mostly India has seen in only in 1990s or in 1980s or 1970s only. At that time only companies have seen this type of inflation, because WPI is 15%. 15% inflation, WPI directly affects the companies, because wholesale price inflation is where the material inflation it means, whereas CPI inflation, it mainly consists of food items, energy, as well as services, whereas WPI, it mainly consists of materials used by the companies. And if you see that the 15% WPI inflation, it's a multi-decade high, and in each and every annual report, majority of the companies, they have disclosed that that inflation is affecting them. And this is one of the slide taken from the annual report of the Britannia, one of the largest biscuit company in India. Parley is one of the largest, biscuit company, and it's an unlisted company, whereas Britannia is a listed company. And if you see that this slide is taken from the Britannia annual report, and they have mentioned that material inflation in FY22 higher than the last 6 years combined. So in the last 6 years combined, if you see the inflation they have faced, the combined inflation in the last year is higher than what they have seen in the last 6 years. And that is what they have shown pictorially. And if you add all these things, it may look slightly higher than what they have seen in the last 6 years, but it is almost 6 years combined inflation they are meaning they have seen in FY22 when combined to in the last 6 years. So each and every company is affected, and FMCG companies affected, chemical companies affected. Almost every company has got affected because of very high inflation. And one of the main culprit for very high inflation is the crude oil prices. Even in yesterday, US inflation came above expected. Mainly three items contributed to the high inflation. One is the energy prices, where crude oil prices are very high, and natural gas prices are very high. The second one is the food prices, are much at elevated level. And third main thing is the rent, which is still at a very high level. So these three key components contributed very high inflation in the US. And even in India, if you see that the high price of crude oil is affecting both on an inflationary level as well as for the government also, because government yeah, is subsidizing some of the oil energy items like LPG and all. So they are also getting affected. Oil marketing companies are getting affected because of high crude oil prices. And if you see that crude oil prices are near to $120, this chart has been taken 2 days back. Yesterday it came above 120 to 120. $122 was the crude oil prices. Brent crude was trading the last 2 days, and 122 is a very high level. And it was trading around 60, 70 just 1 year back. 1 year back, July, if you see that crude oil price was $70. Now it has come to $120. Now what analysts are forecasting is that crude oil may go to $150. That is the forecast given by the oil analyst for the in the next few months, that the crude oil may go there. So it is going to affect majority of the world where energy are imported, and India is one country where we depended almost 85% of our crude oil needs imported. So one way to reduce, India has found one way to reduce the high oil price is by buying Russian crude. And if you see that India buying from Russia told that they were willing to give some discount because of the sanctions put on Russian economy. Majority of buyers are not there. Old buyers who are buying regularly from Russia, they have gone away from that market. And India, by using that opportunity, in spite of geopolitical issues, India has started buying from Russia at around $35 discount. That is what the media is highlighting, that they are buying, India is buying from Russia at $35 discount from the international prices. The agreement was for 6 months, and IOC is the buyer, which is buying from Russian crude. And if you see that the India is buying almost 6 lakh barrels per day from Russia. It was almost negligible previously, and April it has gone up above 2 lakh barrels, and in the month of May it was 6 lakh barrel, and month of June, that is current month, India is buying almost 10 lakh barrels, that is 1 million barrel per day. India is buying from Russia. The total demand for crude is around 45 lakh barrels per day for India, and India is buying around 6 to 10, means around 20% of crude oil India's need. Now India is buying from Russia at a discounted price. So because of India buying from Russia, recently government has reduced prices by around 10 rupees. They have reduced the excise duty for petrol and diesel, mainly because India has started buying from Russia. That is the main reason for that. But how long Russia will give at a discounted price, we don't know. The initial agreement is for 6 months only. The other major negative news for the market is the foreign institutional selling. If you see that foreign institutional has been continuously selling in our market. In the month of last year, FY22, they sold around 18 billion. The main selling started from October month onwards, and that has been still continuing. And from October month till date, they have sold almost 28 billion worth of shares. And if you add these two, it will come only 23 billion only, whereas they have overall sold 28 billion. The balance 5 billion was that in the first half of FY22, there was net inflow of around 5 billion. Whereas from second half only, the selling has started. From October only, the FI selling has started. That is why in the financial year, if you see that the overall selling will show around 23 billion only. Whereas from October onwards, if you see, almost 28 billion worth of shares has been sold by foreign institutions, and we expect that the FII selling will continue at least for next couple of months, because the US market and world market are going to see tough times, and whenever US market falls, naturally globally every other market will fall, and FIIs used to be seller during that time, and we expect another at least 2 months FII selling will continue, and we expect that it has to be compensated by domestic institution buying. And this is the important, very interesting slide. And if you see that in the last 13 or 14 years, FII has sold many times, and every time FII has sold, and there has been sharp fall in our market. The main selling came in January 2008, 8 and 9, that is during global financial crisis, where FII sold $15 billion worth of shares. Right now, between October 21 and June 22, FII sold 28 billion, almost double that of what they have sold in January 2008 January to March 2009. At that time, they sold 15 billion. At that time, if you see that market cap of Indian market was 1.8 trillion dollars, whereas now 3.5. That is roughly around, market cap has doubled in the last 14 years, and FII selling also has doubled. So in terms of market cap, FII is selling almost the same level of what they have sold in January 2008 and October 2021, now the current selling. At that time, 0.9% they have sold. Now they have sold 0.8% of Indian market cap. As percentage of holding, if you see that FII holding at that time was 296 billion, whereas now 665 billion. So at that time they sold 5.2% of FII holding, whereas now in the current sell-off, they have sold around 4.2% of their FII holding. So what they have sold is almost equal to what they have sold in January 2008 and 9. But one big difference was that in between January 2008 and March 2009, FII, when during that FII selling, the Nifty fell by around 58%. Nifty fell, whereas mid cap and small cap fell more than that, more than 65% fell at that time. Whereas now, if you see in the current fall, Nifty has down by around 13 to 14%. Nifty has come down, while mid cap has come down around 18 to 19%. Mid cap has fell. So in spite of equal magnitude of FII selling between January 2008 and March 2009, and now if you compare, the market has fell relatively less, mainly because of domestic buying of shares. And because of FII selling, if you see that ownership has come down from 21.5% to 19.5%, and in NSE 500. So if you see the shareholding pattern of NSE 500 shares, top 500 shares, almost 50% is owned by promoters, and balance 50%. In that, they were owning around 21% in December 2020, and now because of consistent FII selling, that has come down to 19.5%. So that 19.5% was seen only in June 2017, and in June 2019 and December 2020, there was some increase about 20%. Now, because of consistent selling, FII ownership has fell by almost 2%, almost 10%. FII ownership has fell. And if you see who were the buyers, it is mainly domestic institutional public through investment in mutual funds. In spite of heavy selling and heavy sideways movement in the market, net equity flows has been continuously strong, and that money has balanced the FII selling. Even for the month of May, in spite of very weak market, the net equity flows has been 18,500. So whatever FIIs are selling, it has been continuously bought by domestic institutions. And this is the equities as a percentage of Indian household. Because of huge inflow in mutual fund, the domestic in Indian household, the equities exposure has gone up by around from around 3.8% in 2018. Now it has gone up by 4.8%. Almost 1% increase is there in domestic household assets. So FIs are selling on one hand, and on another hand, domestic institutions are continuously buying. The main buyers were mainly mutual funds, which is basically retail investors' money. And this is the Indian household asset ownership. And this data has been taken from RBI, AMFI, and Jeffries. Jeffrey has consolidated this data. And if you see that Indian household assets, almost 50% is in the property. That is, property means the real estate, our own house. The house is an essential for one's family. Therefore, the Indian household, 50% of Indian household asset is in property is nothing surprising. And if you see that the next important exposure is the bank deposit. That is around 15.1% bank deposit exposure is there. Then gold 15%. Then followed by insurance, where many people used to put life insurance, and insurance mainly in India, it is seen as a savings product only. Even all private insurance company, they market insurance as a savings product only. They are not marketing as an insurance product. They market as a savings product, and many of them are putting majority of them are putting money in insurance funds mainly as a savings product. So that has around a 6.2% exposure. Then provident and pension fund 5.7. Then the last one is the equities, which has the exposure of 4.8%. Actually, it was 3.8% couple of years back. Now, because of huge inflow into equities, the percentage has gone up to 4.8. What we feel is that in the next decade, that is from 2020 to 2030, that is another 8 to 9 years, the equity exposure will go up to 10%. From 4.8, it will go to 10%. And where the reduction we are going to see is in the gold. Gold is currently it is 15, and we are expecting after 10 years, if you plot the same pie diagram, the property will be around 50%, equities will be 10, gold will be 10, and the rest will see some small changes we will see. Suppose if bank deposit starts, interest rate starts going up, we may see some increase in the bank deposits happening, whereas the insurance, they may see some reduction. Like that, small change will be there. But the major change is going to come from the equities and gold, where gold is going to see 5% reduction in the overall ownership, whereas equity will see 5% addition in the ownership. Because now the new generation, they are more interested in equities rather than in gold. And that is why if you see that in the last 2 years, 3 years, lot of new demat accounts has been opened. And those who are opening the account, if you see that their age are mainly between 20 to 30. That means they have another 20 years of earnings capacity, and they are putting more money in equities. And gold will mainly be seen as a asset class where you would buy only during marriage, and during the rest of the time you don't buy. It will happen like this, and quantity of gold buying also will come down, and then whereas the same money will gradually move towards equity. And overall, we expect 10% exposure in equity ownership by 2030. And property, if you see, it will remain there, because a property, as a family, one needs a house to stay, and a property will remain around 50. That's what our expectation is. And even if you take in my case, when I go to my native place, that is in Madurai, I have a tremendous pressure from a family member, from my relatives, my in-laws, and to buy a house and give for rent. I have exposure in equities. They are asking me to sell the shares and buy a property and buy gold. Whereas I have most of my exposure, my personal money, that what I am telling, I have exposure in equities only, because my grandfather bought a lot of properties still lying there in my native place. My parents bought a lot of gold. So for my son, I want an equity exposure to him. That's why I am building a big corpus for him, where I am putting all my savings in equities only. Whereas I have tremendous pressure, my family members, especially my parents and my in-laws, who are actually old age people, and they want me. They don't have much trust in equities, and they are asking me to sell the shares and buy property and gold, whereas I will remain in equity. And Nifty PE ratio chart, if you see that, the PE ratio has fell very sharply, 20.5. Now Nifty is trading around 20 PE, that is trailing 12 months PE. It is around 20 PE now. 20 PE, you can't you can't tell either cheap, neither cheap nor highly overpriced. It is in a fair zone now. Historically, if you see that, most of the time Sensex and Nifty PE has been around 17, 18, like that. When market goes up, you used to go above 20. When market falls on a panic, it used to fall below 16. But now it is around 20. What my expectation is that maybe next year the Nifty PE ratio may come to around 17, 16, 17 range. There is a possibility of coming. That means another 10% fall is possible in Nifty PE ratio. So the fall can happen either two ways. Suppose if earnings goes up and market remains at the same level, if earnings goes up by 10% in next 4 quarters, whereas market remains range bound, means naturally Nifty PE will come down by 18. That is one way. And the another way is that if market falls by 10% and earnings doesn't grow, means that at that time also Nifty PE will fall to 18, 17 level. That is purely by fall in the Nifty index. My expectation is that Nifty PE ratio will fall in the range we have seen in 2012-13. In that, you see that 16, 17 PE at that time Nifty was trading, and it was there sideways for the almost 2-3 years. Between 2011 and 13, Nifty was sideways, and we may see the same pattern in coming months. Nifty PE ratio will fall to 16 to 18 level, mainly by earnings growth and by marginal fall in Nifty, and will consolidate for some more time. And after that only we may see some rally in the Nifty. That is what my expectation is. But things are very volatile. Every now and then things are changing, and we have to see how this pans out. And in US economy, already stock prices have fell very sharply. And if you see the Nasdaq, it has come down more than 20%. That is in strong bear phase, the Nasdaq indexes. And in US, there is a huge wealth effect is there on the economy, because each and every individual will have exposure in equities. But in the last 2 years, if you see that another asset class has entered it, that is cryptocurrency, where many individuals are having huge exposure in cryptocurrency in US. And if you see that cryptocurrency has also fell very sharply, and because of sharp fall in both equities and in cryptocurrency, many of them have lost between 30 to 50% in their overall wealth, those who are having exposure in US. And 4 days back, one of our client came in US. I just asked how is their US portfolio is doing there. He said that he lost almost 40 to 50% from the peak. That is what his response is. He has some exposure in cryptocurrency also, and cryptocurrency portfolio also is down by more than 50%, he told. And equities between 40 to 50% loss was there from the peak. That is what he told. And almost everyone has the same impact, impact on the loss. And because of wealth effect and increasing in the, because of negative wealth effect, and because of interest rates now started going up very sharply, Most economies are seeing that negative effect will start seeing in the US economy, and most probably by this current calendar year end or by next financial next first half of 2023, we may see a mild recession. The coming recession won't be much stronger; it will be extremely mild. One of the reason for that very mild recession is that the individual household balance sheet has been extremely strong. Most of them don't have much leverage. Similarly, the corporates also don't have much leverage. Because of the strong leverage, there may be a very mild recession coming in the US, but immediately the recession will go away, and again growth will start coming in. That is what everyone is expecting. Even Raghuram Rajan, our old RBI governor, who is in the US, his feedback also the same. He is also expecting a mild recession in US, and it will be very short-lived, and again the growth will start coming in. Already, if you see the US new residential housing sales, if you see that it has started falling very sharply, and it has come to the range where it was a few years back, April 17, 18. Now it has come to the in 2021 during COVID time, because of ultra loose monetary policy and extreme low interest rate, the new sales has gone up very sharply, and now that have started coming down, and it has started coming in the range what it has seen in the 3 years, 4 years back during normal time, pre-COVID time. And for our country, the main thing which will have impact is the monsoon. Now the monsoon has just started. The first week was slightly disappointing. All India average is more than there is a deficiency of more than 50%, mainly because the rainfall is less in Kerala. But IMD, the government institution, they expect a normal southwest monsoon for 2022. And similarly, the private monsoon forecaster, that is Skybet, they also till now maintaining that this time the monsoon will be normal. If that happens, means this will be the fourth normal monsoon our country will be seeing, and monsoon will be very crucial for agri output, because right now globally there has been a huge shortage of food, particularly wheat and other items. There is a huge shortage, and if monsoon is good, means naturally it will be very good for agri output, and if agri output is good, means naturally rural economy also will be good. Always the monsoon will have a lag effect on the economy. Suppose if monsoon is good, this now means it will get reflected in the economy 6 to 7 months after January. That is in the first half of 2023 it will get reflected. Suppose if monsoon is bad, means the negative impact won't be reflected immediately in the economy. The negative impact will be shown only in the first half of 2023. But whatever maybe, the monsoon should be good, because right now the food inflation is very high globally. Similarly, for our rural economy, if monsoon is good, means naturally the agri output will increase, and it will help our economy. GST collection still very strong, and this indicates that that economy is doing well. But right now the interest rate upcycle has started, and we have to see how it is the interest rate upcycle is going to affect the economy. It will affect the economy 3 to 6 months down the line. Immediately it won't affect the economy. 2 days back, I saw a TV debate in a TV channel called Pudiya Talaimurai. Is there in a Tamil TV channel, news channel? They were debating the RBI interest rate hike. The moderator was asking to one economist, now RBI has hiked the interest rate by 50 basis point, whether the price of petrol will come down from tomorrow, whether the price of biscuit and other eatables will come down tomorrow. He was asking, he very well he know that that the interest rate hike is not going to reduce the prices on the very next day, but still he's asking, telling that the RBI and government actions are useless, it is going to affect only the common man. Like that, he's asking the question to an economist. We all know that the whatever RBI taking steps and all, it will affect only after 3 or 4 months only. It will start affecting the demand situation only after 3 or 4 months, and it will get reflected by a couple of quarters down the line. Whenever RBI increases interest rate, inflation is not going to come down immediately. It will have a lag effect. By 6 months to 9 months, it will start showing in the economy. So the whatever data we are seeing, that a high GST revenue collection, strong auto sales, all these are backward looking data, and the steps taken by US Fed and the global central banks, the impact on the economy will be seen 6 months down the line, not the data we are seeing now. The GST collection will be good, exports will be good, and auto sales will be strong, and the company results will be very good. But we will tell that in spite of all this thing, data are all rate high, still data are good. But if you see that market alone will be coming down, because of what market discounts is that it will discount what is going to happen in the economy 6 months down the line, 9 months down the line. Whereas the whatever data we are seeing now, it's all backward looking data, and it won't have much relevance on the stock prices. Data will be good, whereas the stock price will come down, because stock price tends to discount 6 months down the line data, not the data what you and me are seeing. Exports, it was good only. As I said previously, these are backward looking data. The interest rate hike by US Fed and ECB, the qualitative tightening they are going to do in coming days, it will have 6 months down the line only, it will have impact, not immediately. Results was good, whereas this time if you see that the overall, the aggregate results has been overall good. But if you see the individual companies, many companies sales has gone up, whereas profit has come down, mainly because of sharp increase in their raw material cost, which where the companies could not able to pass on, and they will gradually will pass on. It will take some time, 6 months to 9 months time they will take to pass on. And if you see that for instance paint company, raw material prices would have gone up by 30%. So immediately they cannot hike paint prices by 30% at a one go. They will gradually hike by 5%, 6% every month, and by 6 months to 8 months time, they would have hiked the prices by around whatever the raw material prices has gone up. Sometimes if demand is bad, means they may take even 1 year to 1.5 years to pass on the price hike. Till then the margin will be lower. But if you see the aggregate companies results, that is 2,250 company results, sales has gone up by 23%, whereas the net profit has gone up by 32%, mainly because of 3-4 companies results. Adani Power, where last year this quarter, that is the Q4 FY22, they showed huge profits, whereas because of one-time income through court order, last year they did not had it. Almost 5,000 crores overall profit Adani Power has shown in Q4. That will be missing from next quarter onwards. Similarly, Yes Bank, last year they showed huge losses. This time they have shown some profit. Tata Steel also, year-on-year comparison, if you see, there has been a huge increase in the profitability. And PSU banks, if you see that last year most of the banks were in losses or some marginal profits, whereas this time they have shown huge profits. So because of that, the combined earnings has gone up. Whereas if you see the individual sector wise, like chemical companies, paint companies, FMCG companies, majority of the companies sales has gone up, whereas profit has come down, which shows that there has been a huge margin compression was there. The another main factor which I saw in the current quarter result was that the cash flow from operation has been extremely poor. In company P&L account, they show for 200 crores profit, whereas the cash flow from operation, it will be to 20 crore only, or sometimes negative also, which indicates that whatever profit they have got, it got locked into inventories as well as receivables. That is the main thing. And whenever if you see any analyst who is doing fundamental analysis, the main statement he will look into is the cash flow statement only. He will look mainly profit and loss balance sheet. The importance given by the fundamental analyst are, first they will look into balance sheet, then they will look into cash flow statement, and the third important statement they will look is the profit and loss account. So the priority will be first balance sheet, the next will be cash flow statement, and third will be the P&L statement. And in that, if you see that the cash flow from operations has been extremely poor this time, particularly in Q4, which means that the profits whatever they have shown in the P&L, it has got logged into receivables as well as into inventories. And since the cash flow from operation is very poor, what we are expecting is that the credit growth which has been lacking for the last many years, that will start coming in. Already that is visible, and in the month of May, in the second week, the credit growth for banks has gone up more than in double digit, more than 10%. That is in double digit. The credit growth was in low single digit for many quarters. Now that has come into double digit, which means it is positive for the banks, because if banks are surplus with cash, and if they park with RBI, they will get an interest rate of less than 4%. But if the same money is lent through the corporates, they will get around 8 to 9% interest rate. So almost 4% difference interest rate, they will get it. So the credit growth is extremely positive for banks, and many of them are also asking me. Now RBI has increased the interest rates. All the banks have increased the loan rates. All the banks has increased, but the deposit rates banks hasn't increased till now. Why they are? Many of them are asking. Many clients are asking to me. The deposit rate are not increased, whereas the lending rates has been increased by the banks. What is the reason? They are asking me. The main reason for that is that banks are surplus with cash, and they are keeping the surplus money with RBI through reverse repo. Now the standing deposit facility, new structure where RBI has introduced 2 months back, and most of the corporates are most of the banks are keeping their cash, surplus cash with RBI at a very low interest rate of less than 4%. Now the credit growth has come in. Now what banks are doing is that they are pulling money from the RBI, and they are lending that money to the corporates as well as retail, and they will get high interest rate. If you park the money with RBI, they will get less than around 4%, whereas if you lend that money, you will get 8 to 10% interest rate. And that money, they are the surplus money, they are slowly started lending it. At one point of time, a stage will reach where all the surplus money would have been given to corporate as well as the public. At that time, they may need depositors money, so they will start increasing the deposit rate only at that time, at that point of time. At last year, if you see that the surplus money was 8 lakh crore, surplus liquidity in the system was 8 lakh crore. Now that has come to 3 lakh crore. What we are expecting is that next 3 to 4 months, entire surplus liquidity will get sucked out, and banks will start increasing the interest rate at that point of time. So the interest rate will lag RBI repo rate hike, but it will definitely catch up, but with a lag of 3 to 4 months. And right now markets are looking extremely weak. So the triggers for the market turnaround is the main trigger is the Russia-Ukraine war has to end. Otherwise, we are not going to see any major rally in our market. Time to time, there will be pullback in the market, but for a structural bull market, the Russia-Ukraine war has to end. If Russia-Ukraine war ends means, then we may see a fall in crude oil prices as well as the natural gas prices. and that will be a trigger for the market. And the second important thing is that FII for our market, mainly the FII selling has to stop. Without FII selling stopping, we are not going to see a huge structural rally in our market. So it is expected that either Russia-Ukraine war has to stop or FII selling has to stop. If Russia-Ukraine war stop, only crude oil prices will come down. Otherwise, there should be a deep recession in the global economy where demand has to fall. Then crude oil price may come down at that time. And most important slide. Last time also I put a slide like that. So what investors should do now? So basically, many of them are asking me, say, since I am in research as well as managing some public money, whenever market falls, I used to get two opinions from investors, not opinions. Our clients used to tell market is, one client will tell market is falling. It's why you are holding the shares, you should sell and keep in cash. One certain type of investors will tell like that. And another set of investor will tell that market is falling. Now this is the opportunity to buy. Why you are not buying? Why are you keeping cash? So on a same day, sometimes within 5 minutes gap, I used to get a call like this or a mail like this. Market is falling. Why you are still holding the share? You can sell the shares and keep in cash. That is one mail I will I get. And within 5 minutes, I may get another mail that why are you holding cash? The market has fell. Now it is an opportunity to buy. So when market falls, we get two opinions which are exactly opposite. But if you see in a bear market, actually Nifty hasn't gone into a bear market till now, even though many stocks has gone more than 30%, 50%, 60% like that. Still Nifty is not in a bear market. It is still in a correction market only. So for to distinguish as a bear market, it has the index has to fall more than 20%, whereas Nifty has come down by around 14% only from the peak. 14-15% fall only from the peak it has happened. So Nifty is theoretically in a correction market only, but for any investors, most of the portfolios are down around 20%, which means we are in a bear market. In a bear market, always gives an opportunity to buy good shares at a decent margin of safety. If you buy in a bear market, what you will lose will be only notional. If you buy in a bear market, you will definitely you will lose some money in near term. For example, if you take a stock price, it was trading around 150 rupees 6 months back. Now it has come to 100 rupees. For example, like Indraprastha Gas, you take, it was trading around 600 rupees during bull market peak. Now it has come to 360 levels. If you buy now, definitely it may can fall to 330 or sometimes 300 level also. That means in near term you may lose some money, but after 1 or 2 years, when things gets normalized, the same Indraprastha Gas may go to 450 to 500 level. That means in near term you may lose money, but you are buying a good company at a decent margin of safety where downward risk will be 15 to 20%. But if you see 1 to 2 year down the line or 3 year down the line, you would have seen that at least a 20% CAGR you will get if you buy in a bear market. And many investors, what they are seeing is that which one should avoid doing that, where for example, a stock is trading at 1000 rupees and it has come to 500 rupees. I am buying that company for a single reason that it has fell by 50%. Many of them are doing that, but it's not a correct way. You should not buy a share simply it has fell by 50% or 60% from the peak. It's a wrong way to do it, and you have to see that whether at current price it is worth it to buy. That is the main thing you have to see. So buying a share based on steep fall from high should not be the only criteria, and you have to see the other parameters also, whether the company, if suppose if market bounce back, whether the company will do well, whether the business prospects are good. So all other criteria you have to take into consideration, and then only you have to buy a steep fallen share. And many of them also will do average during the bear market time. They may buy at 100 rupees, and it has fell to 50 rupees, and they may average it. And if it falls further to 30 rupees, they may average further. But by average only if you are confident about company's prospects. If suppose company prospects are uncertain, and we don't know what will happen, means better don't average it, because only if you are very confident on companies future prospects, then only you average the company which you are holding. Otherwise, there are so many companies are available where you can buy another company. Since I have bought one company at a higher rate, there is no compulsion that you have to buy the same company for the sake of doing average. So two mistakes one should avoid is the averaging, since only because I bought it at a high rate, and another one is that buying a share for a single reason that it has fell very sharply. These two one should avoid, and only if the future prospects are good, you have to do these two, and always buy in a staggered way, because near-term market will be very volatile, and one should do only staggered buying. That is a advisable one, because if you buy 100 rupees now, most probably it may come to 90 rupees 1 month down the line, and at the time also you can buy. So always buy in a staggered way. And events to what geopolitical, we have to see how this Russia-Ukraine war, whether it is going to stop now or it is going to prolong for a few more years, that we don't know. That has been watched. Global markets extremely weak. European market also have now started falling, and now US markets are falling, and global markets we have to watch. And the third important thing to watch is the monsoon. So these three we have to have a close watch. Now we will see the recommendations for the current month. Very interesting recommendations I have given this month, and I will explain 1 minute. This time I have selected a recommendation such a way that the price damage should not be high, because markets are volume has come down in the market. Even what will happen is that even a small selling may pull down the individual shares very sharply. So that is why I have selected shares in such a way that the price fall will be limited, even if market conditions are weak. So I have selected 5 companies in such a way that price fall will be limited in weak market condition. The first one is the Bajaj Auto. So Bajaj Auto is going to, it's a cash rich company, and it generates very huge cash from operation. It has almost 19,000 crores worth of cash in balance sheet. The company is going to consider buyback on May 14th, on June 14th, sorry, not May, June 14th, the board meeting. And if you compare Bajaj Auto balance sheet with other two companies, two-wheeler companies, TVS Motor as well as Hero Motor, Bajaj Auto has their business has very high margin. Mainly they export almost 50% of their motorcycles are exported to African countries and other countries where the margin is extremely high, and as well as they focus on high-end bikes. But in the last 2 months, if you see that Bajaj Auto sales has been extremely weak, mainly because of non-availability of semiconductors that has affected the company volume. But we expect that 3 months, 4 months down the line, when semiconductor issue gets solved down, Bajaj Auto will do well, and it's at a high. Their ROE and return ratios are very strong when compared to companies like TVS Motor and Hero Motor. And a cash rich company, they are going to consider buyback. So whenever company consider buybacks, means the downward risk will be less. That is why I have recommended. The other section which is doing reasonably well is the insurance companies, private insurance companies. And if you see that in that SBI Life, we like SBI Life mainly because they have huge access to the customers. Suppose somebody wants to take a loan, housing loan from SBI, means immediately he has been forced to take a life insurance policy. because no one will give a housing loan without a life insurance policy, because something happens to that person means naturally somebody has to pay back the loan. So for any high loan uh, sanction means that person has to take life insurance. So SBI, whenever a person goes and take a loan means immediately he will be forced to take a life insurance policy. So in that, SBI has been gaining. SBI has been have access to huge client base. The third one is the Blue Star, which is an air conditioning company. Right now, the raw material prices, mainly the copper and aluminum prices, have started falling, and business is very good, and AC penetration are low, and Blue Star a company is doing reasonably well, and now with raw material prices falling, their margin may improve from next quarter onwards. If you see, air condition is a seasonal business. Most of the business comes only in the Q4 and Q1. Most of the sales and profitability comes in the Q4 and Q1, and Q2 and Q3 generally will be the very lean period where the sales and profitability will be very less. And sometimes many air conditioning company, they used to show loss during Q2 and Q3, whereas Q4 and Q1 generally used to majority of the profits comes only during that period. And Blue Star, though P ratio looks slightly higher, elevated, we expect that margin improvement will happen, and that may be helpful for the company profitability. The fourth company which I am recommending is the Endurance Technology. It's an auto ancillary company, and once if auto business picks up, means naturally they will get benefited. The other reason why I have recommended the Endurance Technology is the low float. The floating shares is less than 5% in Endurance Technology. As you know that many mutual funds and foreign institutions, they generally used to corner a lot of float in the market, thereby leaving aside a minor float for public. Whenever, if you see majority of companies where the float is very less, generally that share will not fall much even when market falls very sharply, because the mutual funds and institutions, since they are holding majority of the shares, they generally don't sell that share, and they will try to keep the share price at an elevated level. So Endurance, because of very low float level, moreover the price also has corrected from 1,700, 800 to 1,300. We expect that the stock price will remain stable, and if auto business improves means naturally the price also will go up. And the last one is the Federal Bank. As I said previously, that when credit growth goes up means the bank yield will start going up, because the whatever surplus money they are having, which was parked with RBI, now they will start lending it at a higher interest rate. So the differential interest rate will add to the profitability. The differential interest rate between RBI reverse repo or standing deposit facility and the lending rate to the public or corporate, almost 4 to 5% difference is there. That will add profitability to the banks. So these are the 5 companies I am recommending this month. And if you see the last month, M&M did well and has achieved target, whereas the worst performing was Gujarat Gas. It fell by 15%. Actually, last month I recommended the share mainly because the result was good. But now what feedback we are getting is that the natural prices has gone up very sharply, and some of the customers of Gujarat Gas, where Morbi is the region where majority of the tiles manufacturers are there in Gujarat, and Gujarat Gas is one of the major supplier to that region, gas supplier to the region. Now, because of huge increase in the gas prices, many of them are shifting from natural gas to propane. And propane, it is 10% cheaper than natural gas, and it is expected that Gujarat gas volume will come down because of customers switching to propane, and that may affect the profitability of Gujarat gas. That is why, in spite of good results, and if you see in the last 2 weeks, the price has been falling, but we expect this will be temporary, long-term investors can continue to hold. And if you see the Gujarat Gas, they have reduced the debt sharply in the last 2 years. And if you see the last 5 years debt, they have reduced very sharply. And it's a good business. It's a high cash generating business, and we expect once the things settle, it will do well. All other shares one can hold. So this is the last week review, where we are down by 1.5, whereas Nifty has gone up by 2.6.